Imagine for a second that you are walking onto this massive high-tech used car lot.
Okay, I'm picturing it.
Right. But the vehicles aren't cars. They are these cutting-edge AI server racks just humming away in a sterile, climate-controlled warehouse.
Oh, wow.
So you approach the salesman, point to the most advanced model on the floor and say, I want that one.
Naturally.
But the salesman runs your credit and just shakes his head. He tells you that you actually can't afford it.
Bummer.
But then he smiles and says, hey, don't worry. I am going to personally loan you the money from my own pocket so you can buy this server for me.
Wait, what? That makes no sense.
Exactly. On paper, he just made a massive sale, right? His dealership looks incredibly profitable.
Right, sure.
But in reality, no new money has actually entered the system. And today's AI boom, which is basically the absolute bedrock of the current U.S. stock market right now, is built on this exact illusion.
It really is. It's a classic financial shell game.
Yeah.
Just, scale up to a multi-trillion-dollar level.
Right. And so for today's deep dive, we are unpacking a really sprawling, intense analysis by researcher Ed Zitron.
It's a fascinating breakdown.
It really is. And our mission today is to decode this whole ecosystem. We're looking at a financial architecture propped up by hidden debt, creative accounting, and this circular financing that honestly eerily mirrors the lead up to the 2008 crash.
Yeah, the parallels are pretty hard to ignore once you look under the hood.
Absolutely. And the most concerning part for you, the listener, is that the risk generated by this illusion is very likely sitting quietly right in your 401k today.
Which is terrifying, honestly, because
Yeah.
when you pull back the curtain on how this AI infrastructure is actually being funded, it starts to look significantly less like a technological revolution and way more like an intricate web of shadow banking.
Right. And we should clarify the technology itself is real.
Oh, undeniably. AI is doing incredible things.
Yeah, we are not here to debate whether artificial intelligence will change the world. It will.
Exactly. The critical question we are exploring today is purely financial. Will the revenue arrive before the massive debt comes due?
Right, because right now the stakes for regular people couldn't be higher. Real wages have basically stagnated and, retail investors are desperately looking for any way to beat inflation.
So they pour their retirement accounts into the promise of AI.
Yeah, the market has effectively made this monolithic bet on artificial intelligence as like the sole remaining engine for global economic growth.
Which is an incredibly precarious position for an entire economy to be in. I mean, if you look at the capital expenditure required to build out the physical infrastructure for AI.
The data centers, the power grids.
Yeah, exactly. The land, the advanced GPUs. The cost is astronomically high. But if you look at the actual cash flowing back in from businesses and consumers who are paying for AI services today,
It's a massive deficit.
a huge deficit. We are operating on a very tight timeline before the market demands a return on that investment.
So to really understand the sheer scale of the debt being generated, we first have to understand the revenue side of the equation. Or, well, I guess the illusion of the revenue side.
Right. The illusion is key here.
Because if you look at the big tech giants, Google, Amazon, Microsoft, the narrative they sell is that they are providing all this new AI cloud compute to a massive, highly diversified ecosystem of thousands of companies across the globe.
Yeah, you are led to believe there's this booming organic market of buyers just clamoring for server time.
Right. That's the growth narrative that justifies their current stock valuations.
Investors just assume that the billions being spent are being deployed to meet a broad, decentralized demand.
But the data from the sources paints a very different picture, and this blew my mind. If we look at the projections from UBS, they estimate that a staggering 27% of Google Cloud's entire revenue this year is going to come from just two companies.
Just two.
Yeah, OpenAI and Anthropic, and it gets more concentrated. Next year, that number is projected to jump to over 48%.
That's almost half their cloud revenue.
Over $124 billion in Google Cloud revenue, entirely dependent on two startups.
It's wild.
And Barclays reported a similar structural dependency at Amazon. They noted that 13% of AWS revenue comes from those exact same two players, and that's scaling up to 18% next year.
You really have to pause and consider the sheer physical scale of Amazon Web Services here.
Right. AWS is literally the backbone of the modern internet.
Exactly. For nearly a fifth of its forward revenue to be concentrated in two highly speculative, cash-burning AI startups, that is a structural anomaly that should make literally any institutional investor nervous.
Wait, I have to push back here, though, because if, say, a local commercial bank was underwriting a bakery, right?
Oh, yeah.
And the baker admitted that 48% of his daily muffin sales came from just two guys who might go bankrupt next month.
The bank would deny the loan immediately.
Instantly, they would call it a catastrophic concentration risk. So how is Wall Street looking at these numbers from Google and Amazon and just continuing to bid their stocks up?
Because, honestly, Wall Street is currently rewarding top-line revenue growth, regardless of how that revenue is being engineered.
Okay, engineered how?
Through that exact seller financing mechanism you mentioned with your used car lot analogy earlier.
Right.
This is circular financing. Microsoft, Google, and Amazon are taking billions of dollars from their own massive corporate treasuries and investing it directly into OpenAI and Anthropic.
But there's a catch, right?
A huge catch. There is a strict caveat attached to these investments. The startups are contractually obligated to turn around and spend that exact capital on the tech giants' own cloud infrastructure and proprietary chips.
Oh, wow. So they are essentially just buying their own revenue.
Exactly.
Like Google takes $10 billion, hands it to Anthropic, and says, hey, congratulations on your funding round. Now give it back to us in exchange for server time.
That is exactly what is happening.
But wait, how is that even legal? Like, how does an auditor at a Big Four accounting firm look at a completely closed circular loop of cash and sign a clean audit for Google's quarterly earnings?
Well, it operates in a very gray area of corporate finance. But it is legal, provided it is technically disclosed, even if that disclosure is just, buried deep in the footnotes of a 10K filing.
So they just hide it in the fine print.
Pretty much. The auditors sign off because, technically speaking, two separate transactions occurred.
Okay, walk me through that.
So first, Google made an equity investment, which goes on the balance sheet as an asset. Then, Anthropic made a vendor purchase from Google Cloud, which is recorded as top-line revenue.
I see.
So from an accounting perspective, Google gets to show massive revenue growth in its cloud division, and the cash that funded it is disguised as a strategic venture investment.
Yeah, it is so sneaky.
And it goes deeper. Google even adds another layer of abstraction. They buy chips from Broadcom, sell those chips to Anthropic, and then rent the compute capacity back to Anthropic through Google Cloud.
Wait, seriously?
Yeah, they're effectively doubling up on the revenue metrics, funded entirely by their own initial capital injection.
That is unbelievable. And when you pull that circular revenue out of the equation, the core growth of these tech giants looks incredibly weak, doesn't it?
Extremely weak.
The data on Microsoft from the analysis is a perfect example of this. In calendar year 2025, 69% of the year-over-year growth from Microsoft's highly touted intelligent cloud segment came directly from their relationship with OpenAI.
Which is staggering.
If you strip OpenAI out of their ledger, Microsoft's intelligent cloud division would have only grown by 8% year over year.
Right, and an 8% growth rate barely outpaces current inflation. It certainly does not justify the massive price-to-earnings multiples that Microsoft is currently trading at.
Not at all.
The entire explosive paradigm-shifting growth narrative that is propping up the major indices of the U.S. stock market is just heavily dependent on this closed loop of cash.
Cash circulating between a few legacy monopolies and two startups that are burning money at a historic rate. Let's actually dive into that cash burn, because OpenAI's financials in the source material are genuinely difficult to comprehend. We're talking about a company that reported a $20.9 billion loss in 2025.
It's a mind-boggling number.
You literally cannot sustain a $20 billion annual deficit without constantly going back to the well for more capital.
And this is exactly where you start to see highly irregular financial maneuvers designed to present the illusion of forward momentum.
Right.
When a company is losing that much money, they have to continually show investors new revenue streams to justify the next round of funding.
Which brings us to the SoftBank deal discussed in the analysis.
Oh, right.
OpenAI reportedly secured an $800 million revenue injection from SoftBank for a program labeled Crystal Intelligence.
Yeah, that one is highly suspect.
Right. Based on the research, this program seems to be entirely phantom. There is no public-facing product, no enterprise software deployment, no visible deliverables at all.
It functions remarkably like a balance sheet maneuver rather than a legitimate commercial contract. Well, SoftBank is already a massive shareholder in OpenAI, right?
Right.
If OpenAI misses its revenue targets, its valuation drops, which directly hurts SoftBank's portfolio.
Oh, I see.
So instead of OpenAI reporting a revenue miss, SoftBank effectively buys $800 million worth of this nebulous, undefined intelligence program.
And OpenAI gets to recognize that $800 million as top-line revenue.
Exactly, which then allows them to go to other investors and claim their commercial sales are growing exponentially.
It's pure financial padding, and it seems they need every trick in the book right now because their IPO, which was supposed to be the big exit liquidity event for all these early investors, has reportedly been pushed out to 2027.
Which is a huge red flag. In the tech sector, 2 years is an absolute eternity.
Especially for a company that does not generate enough free cash flow to pay its own server bills.
Yeah. If the venture capital markets tighten, or if Microsoft decides they can no longer justify funneling billions into the circular loop, OpenAI and Anthropic face an existential crisis.
And because the ecosystem is so heavily centralized, reports indicate that nearly 89% of all revenue for the broader AI infrastructure market flows from just those two companies.
Right, so if they falter, the entire AI supply chain experiences a catastrophic domino effect.
So we have established that the top-line revenue is being artificially inflated through circular financing and questionable strategic deals.
Yeah.
But that only explains half the equation. How do these massive publicly traded tech companies hide the staggering real-world costs of building out these data centers?
Right. How do they make the bottom line look good?
Exactly. How do they look profitable when they're spending hundreds of billions on physical infrastructure?
Well, that requires transitioning from the mechanics of revenue generation into the highly subjective world of corporate accounting.
Oh, boy.
And the primary tool they use to mask these massive capital expenditures is a metric called EBITDA.
Okay, now, I know our audience is probably familiar with EBITDA earnings before interest, taxes, depreciation, and amortization, but we really need to look at how it is being weaponized in this specific context.
It's definitely being weaponized.
Because as a standard metric, it's supposed to give a clear view of operational profitability.
But the operative word there is supposed. Charlie Munger was famously hostile toward EBITDA.
Really? What did he say?
He bluntly referred to it as bullshit earnings.
Wow. Okay, tell us how he really feels.
Yeah, he viewed it as a reverse float, right? Like a way for management teams to entirely detach their financial reporting from the actual physical reality of their business operations.
I want to unpack that, actually. Why did Munger hate it so viscerally? If it's a standard GAAP or non-GAAP metric that the SEC allows, what is the fundamental deception there?
The deception really lies in the D and the A, depreciation and amortization.
Oh.
When you use EBITDA, or the even more manipulated adjusted EBITDA, the company is essentially telling the public markets, hey, look at how incredibly profitable our core business is, provided you completely ignore the billions of dollars in real-world capital we actually had to spend to build the business.
Right. So the tech companies are incurring massive, immediate cash costs to buy land, build data centers, and purchase, these insanely expensive NVIDIA GPUs.
But they do not deduct those costs from their earnings immediately. They amortize them slowly over time on paper.
Right. But spreading out the cost of a major asset is pretty standard accounting, isn't it? Like if I buy a commercial oven for a bakery, I depreciate it over a decade.
Sure, that part is standard. But the research points out another layer of manipulation here regarding stock buybacks and employee compensation that is it's absolutely wild.
Yes. Walk us through how companies are using their own stock to essentially vaporize their labor costs from the cash flow statement.
It is a brilliant, albeit totally deceptive, loophole. So tech companies require incredibly expensive engineering talent, right?
Yeah, those guys make a fortune.
Exactly. Now, paying those engineers in pure cash would severely drag down their reported earnings.
Right.
So instead, they aggressively buy back their own stock on the open market. They then issue that stock to their employees as compensation. This is known as stock-based compensation, or SBC.
But wait, they still had to spend the cash to buy the stock back in the first place, right?
Well, they did. But here is the trick. Under standard accounting rules, while the stock buyback reduces the overall cash on the balance sheet, issuing the stock as compensation does not have to be reported as a direct cash operating expense on the income statement in the same way a standard payroll check would.
Oh, wow. So on their adjusted earnings reports, a massive chunk of their actual operating expense just effectively vanishes.
Poof, gone.
Oh.
The business looks highly profitable in terms of its operating margins, while the actual cash reserves are quietly being drained to sustain the buyback loop.
That is wild.
Right. Institutional analysts can spot this by digging through the cash flow statements, but the headline numbers fed to retail investors. They look pristine.
It is entirely smoke and mirrors.
Completely.
But the single biggest lever they're pulling, like the true linchpin holding this entire financial facade together, goes back to how they handle the depreciation of the actual AI hardware.
Yes.
And to put this in perspective, for anyone listening who has ever owned a home, imagine you need a new roof.
Okay.
It costs $20,000. Now, if that roof is guaranteed to last 30 years, it's a sound financial decision. In your mind, you are amortizing that cost at a few $100s a year.
Makes total sense.
But if that exact same $20,000 roof begins leaking and completely collapses after just 36 months, you are in a financial crisis.
You're ruined.
You have to find another $20,000 immediately, way ahead of schedule.
And that is the precise dynamic playing out inside these AI data centers. But instead of roofs, we're talking about hundreds of thousands of highly advanced NVIDIA GPUs.
Which are the physical engines of the AI boom.
Exactly. And when these tech companies buy these chips, they have to set an amortization schedule. They have to declare to their auditors and investors how many years they expect this equipment to remain viable before it becomes obsolete and needs to be replaced.
Right.
And currently, the major tech companies are running their amortization schedules based on the aggressive claim that these AI chips have a useful lifespan of 5 to 6 years.
So they are spreading the massive upfront cost of this hardware out over a half-decade on their books.
Correct.
But the reality on the ground seems to contradict that timeline entirely, doesn't it? The analysis brings in the perspective of Michael Burry, the investor who notoriously dissected the fraudulent mortgage-backed securities market before the 2008 crash.
Yeah, the big short guy.
Exactly. What is Burry seeing in these server racks that the tech executives are just choosing to ignore?
Burry is looking at the actual physics and the rapid pace of technological obsolescence.
Okay.
These GPUs are being run at maximum capacity, generating immense heat 24 hours a day, 7 days a week.
They're just being cooked.
Yeah. And furthermore, the architecture of AI models is evolving so rapidly that a chip manufactured today is likely to be severely outclassed by newer models in a fraction of the time it took previous generations of hardware to age out.
Oh, I see.
So Burry is pointing out that a 5 to 6 year amortization schedule is mathematically dishonest.
What's the real number then?
The true useful lifespan of these chips, before they either burn out or just become too inefficient to compete, is likely closer to 3 years.
Wow, so if you cut the lifespan in half, the accounting math just explodes.
Exactly.
I mean, if I told my investors my equipment costs $1 billion a year for 6 years, but I actually have to replace it all in year 3, I have been systematically lying about my profitability.
Precisely. The research estimates that by artificially stretching these depreciation schedules, these tech companies are currently masking somewhere between $72 and $76 billion in impending losses.
76 billion.
Yeah. If they are forced to go back to the capital markets to raise billions to replace their infrastructure twice as fast as they projected, their path to actual cash flow profitability gets pushed so far into the future that it may never actually arrive.
Which brings us to the most critical juncture of this entire deep dive. Because they are playing these accounting games, and because they are burning through unprecedented amounts of capital, looking at the recent filings, Google actually went cash flow negative for the first time since they went public.
Which is a staggering milestone.
It really is. So because of all this, they can no longer fund this build-out solely from their own treasuries. They need external leverage.
They need the banks.
Right.
And this is where the risk migrates from the balance sheets of a few tech companies into the foundational plumbing of the global financial system.
That's the scary part.
Yeah, because the capital expenditure required for AI is so massive that the tech sector has to tap into the credit markets.
But wait, let me stop you there. We have heavily regulated banking in the United States, right?
Yeah.
Supposedly to prevent another 2008. Supposedly, yes.
If you are a major commercial bank, you have regulators scrutinizing your capital reserves constantly. You cannot legally take depositor money and just issue a $10 billion unsecured loan to an AI startup that is publicly burning $20 billion a year with no clear path to profitability.
Right, the regulators would step in immediately.
So how is the money actually getting from the financial sector to the data centers?
Because the regulated banks know they cannot hold the speculative risk on their own balance sheets, they utilize the shadow banking system. They engineer complex financial pathways to move the risk off their books and push it into the broader, unregulated corners of the financial market.
This is the exact playbook from 2008.
It really is.
The research breaks down three specific mechanisms the banks are using to facilitate this massive transfer of risk. Let's dissect them, because this is the exact moment the AI story stops being about technology and starts being about your life savings.
Yeah, this is where it hits home.
The first mechanism is called wholesale funding. Walk us through how this bypasses the regulators. So wholesale funding is essentially the practice of lending to the lenders.
Okay.
A regulated commercial bank has the massive capital reserves, but as we said, they are restricted from making highly speculative direct loans to unprofitable tech ventures.
Right.
So instead of lending directly, the bank extends a massive line of credit to an intermediary, a shadow bank.
What exactly is a shadow bank in this context?
It could be a private equity firm, a venture capital fund, or a specialized private credit firm. These shadow entities operate outside the strict purview of traditional banking regulators.
So the traditional bank loans $2 billion to a prominent venture capital firm, and then the VC firm turns around and loans that exact $2 billion to OpenAI to buy more servers.
Exactly. And by doing this, the regulated bank achieves total plausible deniability.
Oh, because they didn't make the AI loan.
Right. If the banking regulators audit their books, the bank can point to the loan and say, hey, we did not take on the risk of an unprofitable AI startup. We made a highly collateralized standard loan to a prestigious, well-capitalized private equity firm.
Wow, the transaction looks incredibly safe on the bank's ledger.
Very safe. But the actual dollars and the ultimate default risk ended up funding the exact speculative asset the regulators were trying to avoid in the first place.
It is regulatory arbitrage in its purest form.
It really is.
Okay, so the second mechanism is even more aggressive, and it's called credit risk transfer, or CRT.
Yes, CR.
And the analysis explicitly compares this to the mortgage-backed securities that famously blew up the global economy. How does CRT function in the context of AI data centers?
The functional architecture is remarkably similar to 2008. In a credit risk transfer scenario, the regulated bank actually does originate the loan directly to the corporate borrower, say, a company building a massive new AI server farm.
Okay, but they can't keep it, right?
Right. The bank knows the loan is way too risky to hold to maturity. So they utilize financial engineering. They take that corporate debt, package it into a complex financial instrument, and just sell the risk off to third-party investors.
And who is on the other side of that trade? Who is buying up the risk of a highly speculative data center loan?
In many cases, it is institutional capital desperate for yield. We're talking about pension funds.
Oh, man.
Yeah, the massive pools of capital that manage the retirement savings for teachers, municipal workers, firefighters. The bank originates the loan, immediately sells the risk to a pension fund, and just pockets the origination fees.
So the bank's balance sheet is clean. The regulators are satisfied, but the risk has not been neutralized at all.
Not even a little. It has simply been socialized and transferred onto the public.
That is deeply, deeply unsettling.
Yeah.
And it leads directly into the third and most complex mechanism they outline in the research. Originate to distribute, often referred to as the conveyor belt.
This is where the financial engineering really reaches its peak. In this model, the bank acts purely as a middleman and a structuring agent. They originate or gather dozens, sometimes hundreds, of different corporate loans, ranging from standard enterprise software loans to highly speculative AI infrastructure debt. They bundle all of these disparate loans together into a massive pool,
Right.
and then they take this pool and structure it into a product called a CLO, a collateralized loan obligation.
Okay, I really want to break down the physical structure of a CLO because it's so easy to get lost in the acronyms.
It definitely is.
The research uses this brilliant concept of mezzanine debt, but let's expand on it using an analogy that makes the mechanics really clear. Let's visualize the CLO as a massive three-layer cake.
Okay.
The bank has baked hundreds of risky AI loans into this cake, and now they are slicing it horizontally to sell to different investors.
The cake analogy perfectly illustrates the hierarchy of risk and return, which is the whole core concept of a CLO. Let's start at the bottom.
Okay, so the bottom layer of the cake is the equity layer. If you are an aggressive hedge fund and you buy this bottom slice, you have the highest potential upside, right?
Yes.
If the AI boom succeeds and all the loans are repaid with interest, you make a massive return. But you are also in the first loss position. If the AI companies start defaulting on their debt, this bottom layer of the cake is the first to be eaten.
Correct. Your entire investment can be wiped out before anyone else in the structure loses a single dime.
So it's high risk, high reward.
Exactly. The equity tranche absorbs the initial shock.
Then we skip to the very top layer of the cake, which is the senior debt layer. The bank takes this top slice to the rating agencies, and because the bottom layers act as a buffer, the rating agencies stamp this top layer with a AAA rating.
Right. It is deemed incredibly safe.
It offers a very low yield, maybe a few percentage points, but the entire bottom and middle of the cake would have to default and be completely devoured before you, as a senior debt holder, lose your principal.
Yeah, the senior tranche is often retained by the banks themselves or sold to highly conservative institutional investors who just want capital preservation.
Which leaves the most critical piece of the puzzle, the middle layer.
Right, the mezzanine layer, the
Yeah.
middle of the cake. This is really where the trap is set for the public.
So this layer might get like a BBB rating. It offers a higher yield than the ultra-safe top layer, but it lacks the extreme risk of the bottom layer.
Exactly. You get a buffer, but you are still heavily exposed to a systemic downturn.
Now, tell me why pension fund managers, who literally lived through the devastation of 2008, are actively choosing to buy this middle layer. Are they just naive?
They aren't naive. They are structurally trapped.
Trapped how?
Pension funds operate under strict actuarial mandates. They have to generate a specific annualized return, often around 7% or 8%, just to ensure they can actually pay out the retirement benefits they owe in the future.
Right.
But in a macro environment where safe sovereign bonds aren't yielding nearly enough to hit those targets, the pension fund managers are forced to chase yield.
So they have to take on more risk just to stay solvent.
Exactly. They are essentially forced to buy the mezzanine layers of these complex CLLOs because it is one of the few places they can find the return they need, even if it means swallowing the hidden AI infrastructure risk.
Wow. So the bank acts as the ultimate casino. They bundle the loans, slice up the cake, sell the toxic bottom layers to hedge funds, sell the precarious middle layers to pension funds desperate for yield, keep the safe top layer for themselves, and just pocket millions in structural fees.
You nailed it. And when the regulators audit the bank, the system looks totally pristine.
Of course.
The bank says, look, we originated $1 billion in loans, but we distributed the risk. We freed up our capital. Our balance sheet is incredibly healthy.
But the macro systemic risk is massive.
It is huge.
It is silently rusting in the retirement accounts and life insurance policies of everyday people who have absolutely no idea what a collateralized loan obligation even is.
Let alone that their future financial security is inextricably tied to the depreciation schedule of an NVIDIA GPU sitting in a data center in Virginia.
Exactly. We have a financial system that has successfully abstracted the risk away from the originators and placed it squarely onto the broader public.
It's 2008 all over again, just with different acronyms.
So we now understand how the money is moving in the circular fashion. We understand the accounting tricks being used to hide the true operating costs, and we know exactly where the risk is currently hiding within the shadow banking system.
Right.
But what happens when the actual bill comes due?
That's the million-dollar question.
Yeah.
The trillion-dollar question.
Yeah, to truly grasp the precarious nature of this bubble, we have to look at the sheer physical scale of the infrastructure being built right now and contrast it with the actual money entering the system.
And this is the moment where the financial engineering meets the uncompromising reality of physics and thermodynamics.
Oh boy.
The math here goes from merely concerning to entirely irreconcilable.
The research highlights data from an analysis group called Sightline Climate, and the numbers are just staggering. They track the physical build-out of data centers, and they estimate that there is roughly 190 gigawatts of data center capacity currently under construction or in the advanced planning stages specifically to support this AI boom.
190 gigawatts is a massive amount of energy.
Right. Now, to understand what that means in dollars, we have to talk about power efficiency, specifically a metric called PUE, or power usage effectiveness.
Yes, PUE is critical here.
Walk us through how PUE translates 190 gigawatts into $1 trillion bill.
So PUE is a ratio that measures how efficiently a data center uses energy. A PUE of 1.0 would mean 100% of the electricity entering the building goes directly into powering the computing equipment.
Okay.
But that is physically impossible because these GPUs generate massive amounts of heat. You need industrial cooling systems, water pumps, facility overhead, all of that.
Right. You can't just run them in a hot room.
Exactly. So a standard, highly efficient modern data center operates at a PUE of about 1.3.
Okay, meaning what?
That means for every 1 watt of power used to run the AI chips, another 0.3 watts must be spent just to keep the building cool enough so the servers don't literally melt.
Okay. So when you take 190 gigawatts of planned capacity, Apply a PUE of 1.3 to account for the massive cooling requirements, and factor in the cost of commercial electricity, land leases, hardware maintenance. The math is just brutal.
It really is.
Sightline Climate calculates that it will require roughly $1.6 trillion in annual revenue just to satiate the operational costs of these data centers.
$1.6 trillion.
Every single year, just to break even.
And we really have to contrast that staggering $1.6 trillion requirement with the reality of current spending in the market.
Where?
Even if we assume maximum venture capital funding and heavy corporate investment, the two biggest spenders in this space, OpenAI and Anthropic, are only projecting a combined annual spend of roughly $400 billion.
Wait, I want to make sure I'm hearing this correctly. The physical infrastructure currently being built requires $1.6 trillion a year to survive. And the absolute biggest buyers in the market are only bringing $400 billion to the table.
Yes. You are looking at a massive structural deficit. There is a $1.2 trillion gap between the physical cost of the infrastructure being financed and the actual commercial revenue available to pay for it.
1.2 trillion. That's an unfillable void.
It truly is.
But hold on, let me play devil's advocate for a second, because I hear this counter argument constantly from tech folks.
Okay, let's hear it.
People say, in a gold rush, you don't invest in the gold miners. You invest in the companies selling the pickaxes and shovels.
Right, the classic picks and shovels argument.
Yeah, people view investing in these data centers and chip manufacturers as the smart foundational infrastructure play. They are selling the picks and shovels for the AI revolution. Why is that a bad idea?
Because the investors deploying that analogy have the roles entirely reversed. They're falling into a psychological trap.
What do you mean?
You cannot be a profitable pickaxe seller until the gold mines actually exist and are actively producing gold.
Yeah.
In the AI ecosystem, the data centers are not the pickaxes. They are the gold mines themselves.
Yeah.
The massive infrastructure build-out is the mine. The software companies attempting to build consumer applications on top of the AI models. Those are the miners holding the pickaxes.
Okay, that completely reframes it. That makes so much more sense. The investors are remembering the dot-com boom. They remember that the companies that laid the fiber optic cables, the physical pipes of the internet, eventually enabled a multi-trillion-dollar digital economy.
Right. They remember the outcome, but they're entirely forgetting the financial carnage of what we call the gap.
The gap.
Yeah. During the late 90s, telecom companies took on massive amounts of high-yield debt to lay millions of miles of fiber optic cable across the globe.
Right.
They built the infrastructure, assuming the revenue would instantly follow. But the consumer adoption and the monetization models were years away. The debt came due long before the revenue arrived.
Oh, wow.
Almost all of those pioneering telecom companies went bankrupt.
The gap swallowed them whole.
Exactly.
And the research introduces a fantastic term for the people who actually got rich: the inheritance generation.
Yes, the inheritance generation is the key to understanding infrastructure bubbles.
Explain that concept.
So the visionary companies build the infrastructure, take on all the debt, and go bankrupt.
Right.
Then a second wave of entrepreneurs arrives, the Jeff Bezos and Mark Zuckerberg equivalents. They survey the wreckage, buy up all the bankrupt state-of-the-art fiber optic networks and data centers for pennies on the dollar from the restructuring courts, and use that incredibly cheap infrastructure to build highly profitable software businesses.
Right. Amazon and Facebook were basically built on the subsidized ashes of bankrupt telecom companies.
Yeah.
So the current crop of AI investors, the ones buying the mezzanine debt in these CLLOs, are taking on all the catastrophic downside risk to build the data centers today.
Yes.
But they will likely be wiped out during the gap, this long lull before the market figures out how to actually monetize AI at a scale that generates $1.6 trillion a year.
Right. They're essentially subsidizing the infrastructure for the inheritance generation of 2035.
That is just brutal. And as if that unfillable domestic revenue gap wasn't dangerous enough, the research introduces a massive geopolitical variable that could ensure the U.S. companies never achieve profitability anyway.
Yeah, this is a massive curveball.
And that variable is China.
Right.
This is where the thesis gets truly dark. Because while the United States tech sector is obsessively focused on building this wildly expensive, premium AI infrastructure chasing artificial general intelligence at basically any cost, China is taking a completely different approach.
A much more pragmatic approach.
Yeah, they are launching incredibly capable, highly optimized, and vastly cheaper AI models, like the Kimi K3 mentioned in the analysis.
It is the classic innovator's dilemma, just applied on a geopolitical scale.
How so?
Well, the U.S. is building a $1.6 trillion premium product, assuming enterprise clients will pay a massive premium for the absolute best intelligence available. But China is commoditizing the intelligence. They are producing models that are, good enough for 90% of standard corporate tasks. Basic coding, copywriting, customer service. And they are offering it at a fraction of the computing cost.
Wow. So if China successfully undercuts the global market with bargain basement AI, the massive premium revenues required to pay off the U.S. data center debt will simply never materialize.
Exactly. Global corporations aren't loyal. They will just migrate their operations to the cheaper Chinese API endpoints to save money.
And because of the systemic risk we discussed earlier, the fact that this data center debt is not just isolated to Silicon Valley venture funds, but is deeply intertwined with global pension funds, shadow banks, and the core valuation of the U.S. stock market.
Right.
If this infrastructure thesis collapses, it isn't just a localized tech sector correction. It threatens the stability of the entire global macroeconomy.
It really does, which forces us to zoom out and look at the broader macroeconomic picture provided in the research.
Yeah, because if this AI bubble is a powder keg, the global economy right now is basically a room full of lit matches.
Great analogy.
The system is already incredibly fragile before we even factor in a potential trillion-dollar default cycle in the tech sector.
The fragility is systemic and interconnected. The research points to several critical stress points currently straining global liquidity. For instance, you have the severe instability created by the yen carry trade.
Okay, let's pause there, because we see the yen carry trade mentioned in the financial press constantly, but it rarely gets explained in plain English.
Sure.
Walk us through the actual mechanics, like how does the monetary policy of the Bank of Japan directly threaten the valuation of an NVIDIA server farm in Texas?
It is all about interest rate arbitrage.
Okay.
For years, the Bank of Japan has kept its interest rates at or near zero to stimulate their own economy.
Right.
Global hedge funds realized they could borrow massive amounts of Japanese yen essentially for free.
Oh.
Yeah. So they take that borrowed yen, convert it into U.S. dollars, and use those dollars to buy high-yielding American assets, specifically the massive tech stocks driving the AI boom.
So they're just pocketing the difference between the 0% borrowing cost and the high returns the U.S. market?
Exactly.
It sounds like free money, but what is the trapdoor?
The trapdoor opens if the Bank of Japan is forced to raise interest rates, or if the value of the yen suddenly spikes.
What happens then?
If that happens, the cost of the debt those hedge funds borrowed skyrockets literally overnight. They face massive margin calls. To pay back the yen, they're forced to rapidly liquidate their U.S. dollar assets.
Oh, I see.
This means a sudden, forced mass sell-off of major U.S. tech equities, which completely drains liquidity from the exact sector trying to finance this $1.6 trillion infrastructure build-out.
So a ripple in Tokyo can trigger a tech crash in New York.
Precisely.
And on top of that, you have the U.S. Federal Reserve scrambling to manage domestic liquidity, essentially having to tacitly print more dollars to ensure our own bond markets don't seize up.
Yeah, it's a juggling act.
And the research also notes a growing, dangerous reliance on sovereign wealth funds from the Middle East to plug these funding gaps.
The capital requirements are so vast that U.S. tech executives are aggressively courting GCC money. The research even notes the wild geopolitical calculations occurring behind closed doors, pointing to nations like Iran being highly motivated to secure massive tech investments.
They mentioned upwards of $2 trillion in promised regional capital, right?
Yeah, which ties the future of Western AI infrastructure directly to the volatility of global conflict zones.
So imagine this highly fragile, over-leveraged global economy.
Okay.
And then imagine that the gap we discussed earlier becomes undeniable. The enterprise revenue doesn't materialize, the cheap Chinese models flood the market, OpenAI and Anthropic begin to miss their debt payments and edge toward failure.
The dominoes start falling.
Right. If they fail, they wipe out the massive strategic investments from Microsoft and Google. If Microsoft and Google tank, they take down the S&P 500.
Yeah.
If the S&P 500 tanks, the pension funds and the life insurance policies invested in those shadow banking CLOs are completely decimated.
Which forces a very grim but honestly inevitable question from the tech sector to the federal government. Are these AI companies now too big to fail?
That is the exact nightmare scenario the analysis lays out. It seems like the major AI players aren't just building data centers, they are actively trying to corner the US government.
They absolutely are.
They are aggressively lobbying to position themselves not merely as consumer tech companies, but as vital, indispensable weapons systems.
It is a highly calculated pivot. The research notes how executives are actively discussing the military applications of advanced models, framing them as cybersecurity shields and strategic assets, and treating algorithmic weights almost like classified nuclear materials.
Wow.
The companies are preparing to go to the government and say, look, we admit we do not have the commercial revenue to make this a profitable free market business right now, but this is a matter of existential national security. If you allow our infrastructure companies to go bankrupt, China wins the AI war and dominates the 21st century. Therefore, you, the taxpayer, must bail us out.
They are essentially holding a geopolitical gun to the government's head, demanding a taxpayer bailout to cover the losses of their shadow banking debt binge.
That's exactly the play.
And this is where the story connects viscerally back to you, the listener, and the average citizen, because the societal boiling point here is incredibly dangerous.
Oh, absolutely.
Think about your own financial life right now. It is incredibly difficult for a regular person with a stable job to secure a mortgage. The banks will audit your entire life, scrutinizing every latte you bought for the last 5 years before lending you a few $100,000.
Yet, as the research astutely points out, if you are a tech executive who walks into a shadow banking firm and says you want to build a theoretical data center filled with hardware that will be obsolete in 3 years, and you admit it won't be profitable for a decade,
the financial sector falls over itself to hand you billions of dollars in high-risk syndicated debt. It's completely backward.
the analysis dives into the growing public anger surrounding this dynamic and makes a really profound distinction. What the public is feeling is not actually anti-AI sentiment. People generally like the technology. They find it useful.
Right. People love ChatGPT.
Yeah. What they are experiencing is a deep structural anti-corruption and anti-financial shenanigans sentiment.
The public is highly attuned to the opulence of the tech elites right now. They can read the headlines about the egregious circular financing and the phantom accounting metrics.
So if these incredibly wealthy executives break the global economy for a second time in 20 years with high-risk shadow debt, essentially blowing up the system just to build themselves what the analysis refers to as bigger bunkers, while the average person is struggling to afford basic groceries, the reaction will not be passive.
The research uses the word pitchforks.
Pitchforks.
Yeah. And given the context, it doesn't feel like hyperbole. No, it doesn't. If we get a repeat of the 2008 financial crisis, but this time driven by tech monopolies demanding a national security bailout while middle-class pensions get wiped out holding the mezzanine debt of a collapsed data center, people are going to lose their minds.
It creates a tremendous amount of cultural and political instability, layered directly on top of the financial ruin. It shatters whatever remaining trust the public has in the financial regulatory apparatus.
So, if we accept this reality that systemic risk is currently hiding in our 401ks, that there is a massive unfillable revenue gap looming, and that a fragile global economy is teetering on the edge of a geopolitical bailout scenario, what on earth is an individual supposed to do?
Yeah, how do you protect yourself?
Exactly. How do you practically survive if this shadow banking bubble pops?
The very first step to survival is acknowledging what you absolutely cannot do,
Which is?
which is successfully time the market.
Ugh. The analysis uses this incredibly vivid, frankly bizarre analogy to explain why attempting to time irrational markets is impossible, and it is honestly one of the most memorable frameworks I've ever heard.
Oh, the push-up contest.
Yes, the push-up contest.
It perfectly illustrates the limits of rational deduction when dealing with irrational financial leverage.
So imagine you are watching a man get down on the floor to do push-ups. You are trying to predict when he will collapse.
Okay.
You rationally believe he can do 100. If he's an elite athlete, maybe you believe he can do 500 without stopping.
Sure.
But if someone asked you, can he do 5,000, you would confidently say that is physically impossible. The human body simply cannot process the lactic acid required to do 5,000 continuous push-ups.
It defines physics.
Right. Yet the analysis notes a historical anomaly. In 1980, an Indian man set the world record by doing 10,507 continuous push-ups without stopping.
A feat that was allegedly fueled by the consumption of a massive amount of cocaine.
Exactly. And the core point the expert makes is that when you are looking at the stock market, you do not know what the COPE is.
That's such a great point.
The stock market can stay irrational, fueled by the hidden coke of private credit, shadow banking leverage, and circular financing loops, far, far longer than any rational observer expects.
Therefore, attempting to predict when the AI bubble will pop is a fool's errand.
You just can't do it.
You might look at the $1.6 trillion revenue gap and rationally deduce, this system has to collapse tomorrow.
Right.
But the banks and the tech giants might engineer a new financial instrument or secure a new sovereign wealth injection and find a way to kick the can down the road for another 5 years.
And in the realm of investing, getting the timing wrong is mathematically identical to being entirely wrong.
Exactly. If you panic, pull all your retirement money out of the market today, and the market proceeds to double over the next 3 years before finally crashing, you still lost massive amounts of wealth.
So if we absolutely cannot time the crash, what is the survival tactic? The research brings up Ray Dalio, the legendary hedge fund manager, as the blueprint.
Yes. If you look at the 2008 financial meltdown, when the rest of the world was losing their shirts, massive institutions were collapsing, and global markets were down by 30 to 40%.
Total bloodbath.
Yeah. But Ray Dalio's flagship fund actually returned 9%. They made money during the collapse.
How is that mathematically possible when the entire system is crashing? Did he just get incredibly lucky and short the exact right mortgage bonds?
No, it had very little to do with luck or perfect market timing. He achieved that return because he was meticulously, mechanistically diversified.
Mechanistically diversified. What does that mean in practice?
Dalio built a portfolio acknowledging his own ignorance. He assumed he would be wrong about the timing of any given crash. Therefore, he diversified his holdings across fundamentally uncorrelated asset classes so that structurally not all of his assets could go down at the exact same time.
Okay, I see.
When one highly leveraged sector of the economy collapsed, another sector he held was mathematically designed to inversely rise, protecting his principal.
So what are the actionable takeaways for the listener based on this? How do we apply the Ray Dalio mindset to a normal person's retirement account? Let's translate this out of hedge fund speak.
Okay.
First, as we established, acknowledge you will be wrong about timing. Do not try to be a hero and short the tech market tomorrow.
Second, you must diversify mechanistically. You need to actually look under the hood of your portfolio.
Right, because people think they're safe.
Exactly. If you think you are safe because you only own broad, passive S&P 500 index funds, you need to realize that the S&P 500 is currently massively weighted toward the exact 6 or 7 tech monopolies we have been discussing today.
Because of their huge market caps.
Right. Because of their size, they dominate the index. You are heavily exposed to the AI infrastructure bubble, whether you bought AI tech stocks directly or not.
Wow, that's a really important point.
You need to actively seek out asset classes, perhaps commodities, value stocks in non-tech sectors, or specific fixed income instruments that move in fundamentally different directions than the NASDAQ.
Third, and this is arguably the hardest one because it fights against core human psychology. Do not be greedy.
Oh, this is the killer for most people.
The speaker in the analysis tells a very revealing personal story about experiencing a massive, unexpected windfall on a single stock trade. And his immediate disciplined reaction was to sell and take the profit.
Which is the exact opposite of what retail investors usually do.
Always.
The average investor sees a stock skyrocketing and their brain just rewires itself. They think, I am a genius, this is easy, I just have to keep riding it, it's going to double again next month.
But the vital takeaway here is discipline. Have a strict, predetermined number in your head before you even make the investment. When your portfolio hits that profit target, sell a portion.
Take the win off the table.
Yes. Do not let greed convince you to ride the wave all the way up to the peak, only to ride it all the way back down into the abyss when the trillion-dollar gap finally swallows the industry.
The ultimate lesson underlying all of this research is really one of personal financial responsibility. You, as an individual, cannot stop the shadow banks from issuing CLOs.
You can't.
You cannot stop the tech giants from manipulating their EBITDA to hide depreciation costs. You might not be able to save society from the systemic risk created by this massive infrastructure bet.
Right.
But you can save yourself by understanding exactly what is in your portfolio, recognizing the illusions driving the current market, and ensuring you are not overexposed to a highly leveraged sector built on circular debt.
We have covered a massive amount of highly complex ground today. Let's briefly retrace the path we took. We started on that high-tech used car lot, uncovering the illusion of demand created by the circular seller financing loop between tech monopolies and startups like OpenAI.
Right, the snake eating its own tail.
We dove into the corporate ledgers to see how accounting tricks, specifically the weaponization of adjusted EBITDA, stock buybacks, and artificially elongated depreciation schedules for NVIDIA GPUs, are actively hiding tens of billions of dollars in real-world losses.
We then followed the money to see how regulated commercial banks, unable to legally hold that massive unprofitability on their own books, are utilizing the shadow banking system.
Right, the wholesale funding and the credit risk transfers.
Through the complex origination of collateralized loan obligations, they are chopping up risky AI debt and pushing it directly into the pension funds and life insurance policies of the general public, recreating the exact systemic vulnerabilities of 2008.
All while a massive, physically unfillable gap looms on the horizon. The gap between the $1.6 trillion in annual revenue required to keep these new data centers powered and cooled, and the fraction of that money actually entering the commercial system today.
A gap that threatens to wipe out the current generation of speculative investors long before the inheritance generation ever gets a chance to build profitable software on the ashes.
And finally, we discussed the terrifying geopolitical endgame. The reality that if these companies fail to monetize, they will likely hold the domestic economy hostage, demanding a massive national security bailout to prevent foreign competitors, like China, from winning the global AI race.
It's quite the picture.
Which leaves us with a final lingering question, something for you to ponder on your own after this deep dive ends.
I'm ready.
If these AI companies successfully execute that final play, if they convince the U.S. government that their data centers are truly too big to fail and that they must be bailed out with taxpayer dollars to protect national security, does artificial intelligence fundamentally cease to be a free market technology?
Wow, that's heavy.
If your tax dollars ultimately have to step in and fund the physical infrastructure because this high-risk shadow debt model collapses, shouldn't the public, and not just a handful of tech billionaires, own the intelligence grid of the future?
It is a profound question regarding the intersection of private debt, public risk, and the future of global technology. And given the timeline of the impending debt maturity we discussed today, it is a question we will all likely have to answer in the very near future.
Thank you so much for joining us to unpack this incredibly dense, high-stakes topic. Keep diversifying mechanistically, don't let greed dictate your exit strategy, and always keep asking hard questions about where your money really is. See you next time on The Deep Dive.